Over the recent week, we've seen a large spike in volatility across risk assets. Today, we're going to talk about why that's happened and our key takeaways. Over the last week, we've seen a significant pickup in volatility across all risk assets. And this level of volatility is something that we haven't seen for over 4 years. We've seen noticeable falls across most major equity regions, but the standouts being Japan, US small cap, and technology stocks. Now, it's not unusual to have periods of volatility. It's part of the course of being invested and exposed to equity markets. But for multi-asset investors, they can take some comfort from the returns that we've seen from global sovereign bonds or government bonds, but also gold and Japanese yen, which has helped to cushion some of the weakness that we've seen in equity markets. Now, what's caused the weakness? Well, it's a complex interplay of corporate earnings, economic activity, lofty valuations, and also changes in monetary policy, or specifically interest rates. Now, if you think about the key events over the last week, it really started last Thursday, where we had the latest US manufacturing survey, which suggested that the unemployment component was much weaker and actually contracting, which was different to what analysts had been expecting. That was backed up by the labour market reports from the US on Friday, which showed that unemployment went from 4.1% to 4.3%, and that was a bigger jump than what had been expected. We also had key changes coming through in Japan. Last week, the adjusted interest rates, moving interest rate from 0.1% to 0.25%, so an incremental shift, but the Bank of Japan also guided that interest rates would go up in the future. So that caused the Japanese yen to strengthen, and that actually caused an unwind of what is known as the carry trade. In addition, we've also been having last week key corporate earnings results from some of the largest technology stocks in the US. Those earnings somewhat disappointed relative to rich valuations. We saw seasoned investor Warren Buffett, his company, reduce its stake in Apple by over 50%. And there's some concerns that the return on investment from AI is actually lower than what had been hoped for. So the data over the last week suggests that the US economy and the global economy is slowing at a faster pace than initially thought, but it's always worth keeping perspective. Just over a week ago, we had the latest GDP report, the measure of the US economy, which came in at 2.8%, which was much stronger than expected and well above the long-run trend. The US productivity impulse remains strong at 2.4%, and that should offset the slowdown in hiring that we're seeing, but also that the slower wage growth is actually a positive from an inflation perspective and is allowing central banks across the world to start to reduce and lower interest rates. And also just yesterday, we had the latest survey of the US services sector. That suggests that employment is now actually expanding again, and demand has actually picked up relative to the previous report. So it's always worth trying to be balanced and trying to keep perspective. So whilst the last week has been unnerving for investors, it's worth just highlighting that academic research suggests that investors overestimate the probability of a significant stock market shock. And it's in these times that when we've seen significant weakness that actually throw up the greatest opportunities. And that's something that we've seen from our managers here at True Potentials. They've actually looked to buy equities where there's been significant weakness, but also the fundamentals haven't changed. And actually that started to pay off already. Japan up over 10% this morning. So for those investors exposed to risk assets through the True Potential portfolios, you should take some comfort in the active managers that we deploy and also the utilization of advanced diversification that we use to help manage volatility. That's everything from us today. Thank you for watching, and we'll see you tomorrow.